Good afternoon. Today we're going to talk about client acceptance. As we go through Chapter 8, there's a lot of jumping around. If you have the full book, I'd suggest you read those 9 or so pages on analytical procedures. They're in Chapter 7. I think they're helpful. We're going to look at a few pages of Chapter 9 about non-routine transactions and judgments. There's 4 pages on Chapter 9 about the definitions of the element in the audit risk model. The audit risk model I find to be very, very important, so that'll come into most lectures from here on out. A little jumping around today. This is kind of an outline of an audit. We obtain the engagement, perform analytical procedures as part of our risk assessment process. 315 says we have to assess the risk of material misstatement, understand the client, and understand their internal controls. I think you'll see 315 playing a big role today. Then we've got 4 types of test of controls, substantive test of transaction, substantive analytical procedures, substantive test of details. The green relates to transactions. The purple are substantive test. Reporting, and we end up with our audit report. This is my little visual again. If it works for you, good. If not, fine. We've got environmental inherent risk, nobody can control. The other part of ROM, risk of material misstatement, is control risk. So when we combine inherent risk and control risk, we call it ROM, risk of material misstatement. The client can control risk. We test our assessment of control risk with test of controls. So we can't reduce control risk. We assess control risk, but we need evidence to support our assessment of control risk. And we obtain that evidence by performing test of controls. Most of the time when we talk about test of controls, we're talking about transactions, testing transactions. We can perform substantive test of transactions, which are part of detection risk. When you did the vouch and trace project, those were actually substantive test of transactions. You were trying to determine if the balance in the sales account was correct. So you were testing transactions to determine if the balance in the sales account was correct. So those would have been substantive test of transactions. And they're under the control of the auditor. The auditor can reduce detection risk. How does the auditor reduce detection risk? Substantive test of transactions, substantive analytical procedures, and test of details of account balances. Control risk. I've emphasized before, and I will continue to emphasize, you need to know this virtually word for word. The risk that a misstatement could occur, didn't necessarily did, but could. In an assertion about a classic transaction, account balance, or disclosures, as soon as I see the word assertion, I think, well, actually, assertions relate to transactions, account balances, and disclosures. That could be material, will not be prevented or detected and corrected by the internal control. So if it's prevented, there's no need to correct it. So it's prevented, or if the controls detect a material misstatement, then they need to correct it. So that's an and. Client acceptance. The book's going to have a lot of things on client acceptance. The 800-pound gorilla is the integrity of management. If management has high integrity and management wants to produce financial statements that are free of material misstatement and that conform to GAAP, then you're probably in pretty good shape. If management is trying to misrepresent their financial position or the results of operations, you've got a problem. Management can fool the auditor when they want to. Management knows this. It's 24/7. So management is better at it than you. Page 231 has a list of what we do to accept a client. First, we've got to figure out why do they need an audit? Why are they paying somebody to audit their financial statements? So we'll probably do a new client investigation. We're going to soul search. Do we have the competence and knowledge to perform a good audit? Then communicate with the predecessor auditor. We'll talk about that. Risk. Who are the intended users of financial statements? What are they going to use the financial statements for? Independence and the engagement letter. So the three in red: communicate with the predecessor auditor, risk, and independence are the three biggies I'm going to focus on. There's an auditing, this is an old cover from an auditing standard. So they sent me one of these back when I was still an active member of the AICPA. Statement on Auditing Standards is a required communication between predecessor and successor auditor. What are the four big questions? Well, they shouldn't be equal. So if I ask a 5-point question on a test and say, what are the 4 objectives of our communication with the predecessor auditor? Integrity of senior management will get more points than the others. That's the most important one. The integrity of senior management of the client. Disputes with the client over accounting principles. Disputes with the client over audit procedures. Disputes with the client over fees. Now, disputes with the client over accounting principles, you can substitute dispute with the client over GAAP. That's fine. Now think about the financial statements. Who is responsible for the financial statements? Management has to understand GAAP. Management has to interpret and apply GAAP. Is it possible for management to understand GAAP, the auditor understands GAAP, and have a disagreement over the application of GAAP? Yes, it is. Okay. Disputes with the client over audit procedures. Audit procedures. Management won't let us do some of the procedures we want to do, some of the procedures we feel we should do to perform an acceptable audit. I don't want to see gas here. Okay, it's audit procedures. GAS is not about audit procedures. GAS is about objectives. And the client is not responsible to be an expert on GAS. We are. So we may have disputes over which audit procedures we perform, but they've got no business telling us about GAS. Dispute with the client over fees. The successor auditor is responsible for initiating the communication with the predecessor auditor. The communication has to start with the successor. The predecessor is probably not happy. In most cases, they didn't want to lose a client. So the the successor auditor is responsible for the communication, and also the successor auditor is now responsible for performing an audit that conforms to generally accepted auditing standards, and one of those standards says communicate with the predecessor auditor. Confidential client information. So the predecessor auditor is going to have to communicate with the client and say, I've been asked to share information with the successor auditor because some of this information is confidential. We honor confidentiality. So what if the client refuses to grant them permission to share that information? To me, that's a big red flag. So if the predecessor auditor comes and says, oh, I can't tell you that, it's confidential information, I am the client, will not allow me to share that with you. To me, that becomes a big red flag. Do I really want this audit client? Now remember, as I say that, I sit here with tenure and a defined benefit pension plan. The audit partners are running a business. They have to have, it's easier for me to sit on that high moral ground. But the audit partners, they've got to run a business. They have to pay salaries. They have to do lots of things. So it's a lot easier for me to say that than it may be for the audit partner. The engagement letter on page 234, please read it once. It will not be on the test. This is our contract with the client. So when we talk about breach of contract, this is our contract with the client. So read the engagement letter once. It's very short. And it won't be on the test. Don't try and memorize it. Just read it and think about what it says. The next lecture will be on independence. Hope you have a good day.